In this presentation, I'm going to show how a bond issued at a discount affects the interest expense that we realize on that bond. So I have it laid out in T-account form here. I've got the asset and liabilities account shown over here, and they're part of the balance sheet. And then over here, I've got the interest expense that we recognize on that bond, and that's part of net income on the income statement. So let's look at our example here. We issue a bond with a $100,000 face value. It has a 9% stated rate of interest, and it's for 5 years with 10 semi-annual payments. And then we receive $96,150 for that bond, and that's based on a 10% market rate of interest. So you can see the difference here already. You got a 10% market rate of interest compared to the 9% stated rate of interest here on the bond. So we need a balancing account between the cash amount here and the bonds payable. And what we use here is a discount to bonds payable. Now this is a contra account to bonds payable, and it reduces the bonds payable amount. So our balancing entry here would be $3,850 to the debit here of $3,850. Now this discount on bonds payable is actually an increases our interest expense. So it's an added interest expense that we have to recognize on this bond. Now if we go down here, we look at our interest payable. Those are those semi-annual interest payments that we pay to our bondholders, and those are based on a 9% stated rate of interest or 4.5% per semi-annual payment. And you take the 4.5% times the $100,000 face value, and you get a $4,500 payment that we pay to the bondholders each period. Now going up here, we look at our interest expense. Now our interest expense here is greater than the interest, the payments that we make to the bondholders. You can see that here. And that's because of the discount to the bonds payable. That this discount here is actually an added interest expense that we have to pay on that bond. Okay, let's look at how this discount to a bonds payable increases our interest expense. So we issue a $100,000 face value of a bond, and we receive only $96,150 for that bond. So we have a discount amount here of $3,850. Now that's $3,850 less than its face value here. So what this $3,850 is, we have to pay that back here essentially, and plus the $100,000 face value, and then those 10 semi-annual interest payments of $4,500 each. So this discount amount increases the expense that we have to recognize on that bond. So looking up here at this discount to bonds payable, that's used to amortize the carrying value of this bond. And would be $96,150 at the issue date here, and we amortize it up to its $100,000 face value at its maturity date. Now the interest expense here is based on or calculated on adding the discount that we amortize each period on that bond to the interest payments that we pay to our bondholders. Now those interest payments are those semi-annual interest payments that we pay based on the stated rate of interest or 4.5% per period. So we can look up here and we can see that our interest expense of $48,866 is greater than the interest payable here of $45,000. And that difference here is really the discount to bonds payable. So you add this discount to bonds payable to the interest payable amount here, and you got the interest expense here. Now that's just a review of the journal entries for how you would enter this discount to bonds payable and calculate the interest expense based on this interest payable amount here. So in review, this discount, or the amount that we received, would be less than the face value here, and it represents an added interest expense on that bond, and essentially we have to pay that back.